Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about WORTHINGTON Steel INC quarterly report. Worthington Steel Inc. offers a diverse range of steel processing services to various industries across North America. The company's product portfolio includes carbon flat-rolled steel tailor welded blanks, steel, automotive and electrical steel lamination stampings, aluminum tailor, welded blanks. These products cater to several key sectors. 1. Automotive. 2. Construction. 3. Machinery and equipment. 4. Heavy truck. 5. Agriculture. 6. Energy. The decline in Worthington Steel Inc.'s stock price by 11.65% over the past year can be attributed to a series of disappointing quarterly earnings reports and investor concerns about market conditions. The company has reported consecutive quarters of decreased sales, lower earnings, and reduced operating income, with net sales declining by as much as 15% in some periods. Investors have been particularly concerned about Worthington Steel's ability to navigate the current market headwinds, including softening demand from mill customers and inventory losses. The company's acknowledgement of operating in a soft market has further contributed to investor apprehension, leading to significant drops in its stock price following each earnings report. While the company reported better-than-expected adjusted earnings per share and revenue in one quarter, this was not enough to offset investor concerns about future profitability, resulting in a 13.57% decline in its stock price. Overall, Worthington Steel's struggles with declining sales and reduced earnings have been the primary drivers of its stock price drop over the past year. The primary drivers of revenue growth and decline can be identified from the financial summary. On the growth side, key factors include a 15% increase in Product A revenue, a 14% rise in Product B revenue, and a 7% boost in Service C revenue. The automotive end market also saw significant growth, with a 56% share of total revenue, up from 51%. Direct revenue increased by $49.6 million, or 6.3%, while direct tons sold rose by 6%. On the decline side, toll revenue decreased by $10.7 million, or 24.2%, due to lower toll volumes and softening demand from mill customers. The closure of a toll processing manufacturing facility in Cleveland, Ohio also contributed to this decline. Overall, these factors highlight the importance of diversifying revenue streams and adapting to changes in market demand to drive growth and mitigate declines. Net income experienced significant fluctuations between 2024 and 2025. Initially, it decreased by 15% on page 2, but later increased by 29.7% to $36.8 million on page 7. This increase was followed by a smaller rise of 19.8% to $38.6 million on page 9. However, net income plummeted from $43.1 million to $2.3 million on page 20. Profit margins also underwent changes. On page 2, the profit margin declined from 12.5% to 10.8%. Conversely, gross and operating income margins increased on pages 7 and 34, respectively. The gross margin rose from 12% in 2024 to 13.2% in 2025, while the operating income margin increased from 5.2% to 5.6%. The reasons behind these changes varied. Higher raw material costs, pricing pressure on finished goods, and increased competition contributed to the decline in net income on page 7. In contrast, restructuring activities led to a significant increase in net income on page 15. The company's financial performance indicates a concerning trend regarding its operating cash flow. Despite achieving positive operating cash flow of $54.6 million in 2024, the company has experienced negative operating cash flows in both 2025 and the 3 months ended August 31, 2025, with a net loss of $6.3 million. This conflicting information suggests that the company is currently struggling to generate sufficient positive operating cash flow. The company's debt level and interest expenses have experienced notable increases over the past year. Total liabilities rose by 19.3% from $763.9 million to $912.4 million, primarily due to higher borrowings from the credit facility and debt assumed in the Sitem Group acquisition. Consequently, interest expenses have also increased significantly, with a net increase of $300,000 million and an absolute increase of $0.3 million. The most substantial change occurred between 2024 and 2025, where interest expense rose by $300,000 to $2,900,000. Management's outlook. A positive note with caution: the company's management is optimistic about its outlook, citing positive growth in North American vehicle production. The deployment of AI technology will enable teams to focus on high-value tasks, driving business value. However, the agricultural market is experiencing softness due to weakening demand. Despite this, the company expects benefits from the recent interest rate cut by the U.S. Federal Reserve. Management acknowledges potential risks from tariffs and trade policy uncertainty, but is managing exposure through price negotiations and financial instruments. The company has access to adequate resources for at least 12 months and plans to continue accessing capital markets if needed. However, uncertain economic conditions may impact its ability to access capital in the future. Overall, management's outlook is positive, with a focus on navigating potential risks and uncertainties. Worthington Steel's dividend policy. Overview: Worthington Steel has a history of paying dividends to its shareholders. The company declared cash dividends per share at $0.16 for both 2024 and 2025, indicating a consistent dividend payout policy. Additionally, the company paid out significant amounts in dividends, with $8.1 million paid during the 3 months ended August 31, 2025. The company's commitment to paying dividends is evident through its quarterly cash dividend declarations, with the most recent one being payable on December 26, 2025. This demonstrates Worthington Steel's focus on returning value to its shareholders through regular dividend payments. Concerns about inventory buildup or supply chain disruption exist. The company faces potential concerns regarding inventory buildup and supply chain disruption. Declining steel prices may result in significant losses of $5-10 million in Q2 FY 2026, making it challenging for the business to manage its inventory effectively. Furthermore, disruptions in delivery from major suppliers could lead to difficulties in obtaining alternative supplies, exacerbating the issue. Uncertainty surrounding global trade policies and tariffs may also impact customers' supply chain decisions, while volatility in raw material prices due to industry factors beyond control adds another layer of complexity. The increase in average steel prices over the prior year period has already led to higher inventory levels, highlighting the need for careful management of these risks. That concludes the financial summary for WORTHINGTON Steel INC. Feel free to comment below, and I will be happy to answer them when possible.